Hi there, eToro. It is Monday and it is time for my weekly review. I'm back in London, so I'm able to do this by video. Let's take a look at what moved the markets last week. All right, beginning with stats. There's a little bug in the chart at the moment, so I can't add more than one symbol to a chart, but the S&P 500 over the past 12 months has returned roughly 30%, and my portfolio has returned about 33-34% over the same period. Zooming into the numbers a little bit, so I like to look at the winners and the losers for the past week. The stock that experienced the biggest decline, the biggest loser of the past week, has been ASOS by far, having lost about 10%. It was a little bit more actually. The markets have opened up a little bit as of this morning. So there have been various things that have affected the ASOS stock price. This company, the stock price moves quite a lot on expectations for margins. Operating margins have always been a little bit tight for ASOS. The weird thing is that if this was a US company, I think that there'd be a lot less concern about operating margins. Companies do need money in order to run and expand, but ASOS has been rapidly expanding for a number of years. Their business model, their management team, they've all proven themselves time and time again. And in fact, the company is moving into a high growth period as it expands across the US market and the EU, having started in the UK market initially. So the major reasons that the stock price has fallen, and you can see that the recent high back in February and March was nearly, these numbers are in pence, was about 6,000, close to 6,000 pence, and the price has been as low as 350 pence very recently. So the reason for the dip last week, and this affected a number of UK stocks, is that there are just shortages of things in the UK, but in particular lorry drivers. Lorries are trucks in the UK. So truck drivers to transport things around. There is an enormous shortage of truck drivers in the UK, and this has affected anything that relies heavily on trucks to ship stuff. So this is, I think, part of the reason that the ASOS stock price has dipped, but also concerns about margins, because globally there's a shortage of stuff, whether it is shipping capacity, materials, people for labor, and this is driving costs up, which impacts margins and therefore profitability. So I think that these two things have been impacting the stock price. The company does report earnings, I think it is mid-October-ish. I need to double check that, but soon, let's say the next couple months. And there were some broker downgrades late last week. The funny thing is that the broker downgrades downgraded their target prices to around 6,000 pence, so massively up from where the stock price is now, but that still for some reason caused the stock price to tumble. I encourage you to look at ASOS's investor relations website. The materials that they create are very accessible. It's not just that you can get the tabulated raw data if you want, but also they make it easy for you to pull out key numbers. And you can see, for example, that they are looking to massively expand their capacity. The company did have a little bit of a stumble a few years ago as they started to expand in the US, but that's behind them now. And now they are putting a lot of money into expansion, which is another reason why I'm not sure that there's so much focus on margins. Margins will be hurt by companies that are looking to, and are not just looking to, but have expanded rapidly. So this is a company that relies heavily on all forms of shipping, and all of these things are going up, so they're hurting margins. But this is going to be a blip. Supply chains might stay like this for a while. I don't think it's going to be sold in the next month, but eventually they will be sold, and at that point the company will have expanded and margins will begin increasing to a more reasonable point. Okay, I also wanted to look at the winners, and you can see that in the portfolio, Chinese companies have done very well through the last week. This is despite more regulatory information hitting the markets, and that makes me think that Chinese stocks might have found a bottom. I'm still sitting on the sidelines. when it comes to direct investment. I'm not going to jump in just yet. There are some good opportunities, but sentiment needs to turn, and we need to see some buying volume return to Chinese stocks before I'm going to get in. I want there to be a party in the stocks. I don't want to be the first one at the party. So I want to make sure that there is a party before I join it. You might have also seen that I have added this Dutch name to the portfolio over the past week, and there has been a South African company that I've wanted to invest to buy on eToro for a long time, but it doesn't exist. Well, it doesn't exist on eToro, but this company is the investment arm of that company, and they own a huge chunk of Tencent, as well as a number of other innovative companies across India and South Africa. This company is so interesting that I'm going to devote an entire video to it. But for now, I've kind of used it as a proxy for Tencent. So an indirect investment in Tencent, but also India and South Africa. I mentioned earlier that part of one of the biggest topics that we've seen through the past week or so has been shortages of stuff. And that stuff could be shipping capacity, it could be people to do work, it could be raw materials. And this is manifest in some very interesting ways. I've just picked out a few examples here. So JD Wetherspoons is a pub owner. They own a lot of land too, and I think that the value of the land that they own is massively undervalued, but that's a story for another time. So they've experienced shortages of beer in the UK, and this is in part due to what I mentioned before, a shortage of drivers being able to get stuff from point A to B within the country. It's not just the UK that is experiencing shortages. So we've heard about the semiconductor shortages, for the chip shortages, I think is the term that most news outlets are using for automakers. So Ford, amongst many other automakers, has seen huge declines in sales because they cannot make enough of the stuff that they need to sell, which are automobiles. I don't think this will be long-lived, but the point to note is that the shortage has been longer than analysts were saying. So there were hopes that it would be more or less dealt with by June, and we are now well beyond June. I'm taking this as confirmation that some of my other semiconductor names are going to do very well in the future as chip shortages outside of the auto industry also continue. That's why I'm still very bullish on the likes of Micron and AMD. What's interesting, but not in this article, is that a lot of companies like Ford, BMW, etc., despite the decline in sales, are seeing a massive uptick in EV sales, electric vehicle sales. So it's nice to see that people are buying into that narrative. It's good for the world. So those are just two examples, but I've pulled up TAN here. But anything that's heavily involved in manufacturing, has a global supply chain, relies on shipping, their numbers, the sales and revenue numbers, the revenue and earnings numbers are going to take a knock. And I think we're going to see that in the next quarterly earnings report, maybe the one beyond that too. So just bear that in mind, but also know that supply chains will eventually sort themselves out. It might take a few quarters, but it also creates opportunities. There are lots of good stocks that are going to be cheaper because of the short-term expectations by the market. Okay, on to the second big news item that moved things last week. So the US economy created far fewer jobs than was expected. So roughly a third of the jobs that were expected. And looking at the details, it seems that the largest impact area has been leisure and hospitality, travel, leisure, and hospitality. And this is because in the US in particular, as the virus has spread, cases have obviously increased massively, and deaths in the US are rising very fast too. People have been sick, so they can't go to work, but also people haven't been going out because they want to avoid getting sick, and employers anticipating less footfall. So for example, if you are a retailer and you think that fewer people are going to come to your business to buy stuff, you're going to hire fewer people, you're going to create fewer jobs. So this seems to largely have been down to Delta, looking at the numbers. And I think that for certain areas, particularly business travel, this probably means that we're only going to see the businesses make material improvements early next year, or even towards the middle of next year. So I'm becoming a little bit more bearish on things such as business travel, even domestically within the US. And I'm wondering if I only have one stock that is based on US recovery, and I'm wondering if I need to pare that back. So I'll decide that in the next few days. The US market is closed today, but this is a very interesting data point. The other implication is that the Fed might need to not taper as soon as they had originally thought. Now, we don't know what the Fed was thinking definitely. We know that they were probably going to start tapering towards the end of this year, but the Fed might need to keep support in place for a little bit longer. We know that the two things that the US Fed were looking at were the inflation numbers, but also the jobs numbers. They want to have a larger portion of the population at work before they start removing any support for the US economy. So I think this is part of the reason that we didn't see the markets fall when this data came out. In fact, the market shrugged it off and carried on higher in most cases. And I think it's because of this expectation that the Fed is going to continue with the very friendly environment for businesses and stocks in terms of growth. What is quite interesting, so this is an article about exactly this topic, the jobs report. So you can see this very blurry picture from Goldman Sachs, and it's saying you can see that most of the growth that we've seen recently has been in the stay-at-home areas, so those in orange, whereas there's been a contraction in those areas in terms of business that have required people to go out and do stuff. So this is pretty obvious. I just spoke about that. But what is interesting is that we seem to have the opposite in Europe. So in Europe, vaccinations have been less along political lines than they have in the US. What this means is that within Europe, a very large portion of the population has been vaccinated, and it's pretty homogenous. So the people that were most at risk were vaccinated first, and a large number of them have been vaccinated, whereas in the US, the picture is a little bit different. So what's interesting here is that we have pre-COVID levels of the green dots, and the change in terms of growth are the blue dots. And for the domestic categories, so the reopening domestic categories, so for example, restaurants within Europe, growth has been pretty decent. So this is interesting. I think that this is pretty good confirmation that if you are focused on the right reopening trades within Europe, you're probably in the right place for now. Okay, in terms of what is happening in the coming week, we can see some of the economic events that are going to happen through this week. Ones that move the market the most tend to be the US data points. So jobless claims, I think on Thursday could be one that might move the market. It's certainly one that will be watched quite closely. For those of you that are invested in the UK markets, so the construction PMI data that came out today was a big miss and has been taken as a slowdown in growth in the UK economy for some of the reasons that I mentioned previously. And then on Friday, we get a whole bunch of interesting data out of the UK. So manufacturing production, PMI data, GDP data, which I expect at least some of this is going to move UK stocks on Friday. Of course, the Delta variant continues to move the markets, coronavirus in general, really. And our world in data is a pretty good place to look at these stats. So I've just used the default view on some of the major economies in the world, and you can see that cases have been rising quite dramatically in several areas, including the UK and the US. Other countries, major economies, seem to be doing a little bit better. But the good news is that for most of the same major economies, the daily confirmed death numbers are still quite low, except for the US, for reasons I mentioned before. There are large portions of their vulnerable population that are not vaccinated, I think because of politics. All right, so that's it for today and last week. Just as a summary, I you can probably feel that there's a lot of nervousness in the markets, largely because of the Delta variant and its effects on the wider economy. Supply issues in all their various forms are concerning investors at the moment. These, I think, are impacting stock prices and probably will continue to do so for the next quarter or so. But this is not a permanent situation. It will change eventually. And I think that the good news is that instead of having an explosion of growth that is unsustainable, these things are slowing down GDP around the world, which to some degree, hopefully makes it a bit more sustainable and extends that growth through 2022 and potentially beyond. All right, have a great week, and I will talk to you soon. Goodbye.